Hello and welcome to the February episode of First Look ETF. I'm Stephanie Stanton with ETF Guide. It is great to have you with us. Coming up on today's show, you'll learn about a new lineup of investment-grade corporate bond ETFs that aim for targeted durations and monthly income. Also, we'll tell you about a recently launched suite of ETFs focused on the energy market. And finally, we'll examine an option strategy ETF that aims to solve the income challenges facing traditional all stock and bond portfolios. But first, to kick things off, we've got Douglas Yones, head of ETFs from the NYSE. Douglas, it is great to see you as always.
It's good to be back, Stephanie. Hey, it's February. It is the month of love. Whether you love the Super Bowl, you love Valentine's Day, or you love ETFs like we do, we're excited to be back in action.
Yeah, we are so excited as well. Let's start out as we always do. We want to get the latest update on 2024 ETF launch activity. How is everything looking?
I mean, the year has started with a bang. We've got 63 ETFs have launched already this year, raising over $30 billion in new assets under management. All the trends we were seeing last year in our previous episodes, hopefully you've been watching them, have continued into 2024. We think it's going to be a great year for ETFs.
Yeah, you know, we continue to see tremendous innovation as well in the ETF marketplace. In some cases, it means breaking open entirely new asset classes like cryptocurrencies, which I know we've talked about. Other cases, it could be exposure to traditional asset classes, but maybe with a little bit of a fresh spin. What does it mean for both investors and financial advisors when we have all of these new emergent trends?
Yeah, I mean, you're spot on. This is all about the ETF story, which is providing access to parts of the industry that historically not all of us had access to. There's over 3,420 ETFs now in the United States with over $8.3 trillion in assets under management. And guess what? We're still breaking new ground. Some of those examples in the last year even of new product categories, in addition to the digital asset space, the commodities market, we're going to talk about it today. New ETFs that cover coal, natural gas, nuclear energy, targeted fixed income. I say it again, targeted fixed income. We know there's more money invested in fixed income than there is in equity, and now ETFs are providing a way for advisors to target specific areas. And look, active management, we've talked about it month over month since the beginning of First Look, the very first episode. This year, 68% of all ETFs coming to market are actively managed, and you're going to hear from one of the top active managers that historically you didn't have a way to access, but now with ETFs you can.
You know, it really is amazing. I was just thinking about that. We are now in season 4, First Look ETF. We've really seen the marketplace explode. So that's been really incredible to watch. What other ETF trends are you guys monitoring right now?
Yeah, Stephanie, I know we both say it each and every month, and we mean it. It is a focus on education. Whether it's going back and watching the first few seasons of First Look, you'll find all about the new king and queen as we go through seasons 1 and 2. But seriously, go back, watch those previous episodes. They all still stand. You can subscribe to our podcast series, whether it's First Look podcast or the ETF Central podcast, or frankly, invest in yourself. Become a certified ETF advisor, a CETF. You can find that also on ETF Central. It's all about taking the time, learning about ETFs, following First Look. Like us, follow us. You're going to continue to learn and invest in yourself all through ETFs. And it's brought to you by none other than the New York Stock Exchange. We call it every single day, but we mean it. We're the home of ETFs.
Absolutely. First Look ETF, NYSE, it's the place to be. Douglas, thank you so much. Keep up the good work. It's great to see you.
Thanks, Stephanie. I look forward to watching the rest of the episode together with our audience.
Yeah, we've got a great episode ahead. Just a quick reminder, though, that First Look ETF is available on major video streaming platforms, and we're pleased to announce that Apple TV has just been added. So just download the ETF Guide app on Apple TV. Plus, you can still find us on Amazon Fire TV and Roku, along with major podcasting platforms like iTunes and Spotify. The global transition in the energy markets to a carbon neutral goal is here to stay. The International Renewable Energy Agency estimates that a whopping $35 trillion of capital investments through 2030 is required to stay on track. So how can you position your portfolio to capitalize on this? Well, joining us to discuss a new lineup of ETFs that plug into the energy theme is Tim Rotolo, founder and CEO of Range Fund Holdings. Hi, Tim. It's good to see you.
Good afternoon. Thanks for having me.
So Range recently launched a suite of ETFs targeting different energy themes, from nuclear to offshore oil services. Why do you believe energy will be the driving force of global markets in the coming years?
I think broadly, we think energy is life. And for the past few years, there's been a significant movement away from more fossil fuel oriented power sources. And even nuclear was excluded for quite some time. And I think the events of 2022, particularly the invasion of Ukraine, has made many investors recognize the fragility of the energy system. And there's this concept called the iron law of electricity by this guy, Robert Bryce, basically just that, people and governments are going to do whatever they can to make sure that they continue to have electricity. And if you look out, to 2050, electricity demand is going to more than double. And whether that's AI or just consumer cultures in places like China and India expanding and additional consumption coming online. And we just look at the universe of investment opportunities that have been created in an ESG world, like offshore oil and gas, significant underinvestment, like nuclear power, which is experiencing an incredible renaissance as governments around the world recognize that we need clean baseload power. LNG, same thing. This is a bridge fuel to the energy transition. And so we looked at the universe of options available to investors and realized that, as generalist investors, there weren't a lot of great solutions. And, our business model is about trying to find non-consensus ideas, building proprietary indices that allow investors to get pure play exposure to those themes and releasing them. We were very successful with URNM in the uranium space. And, we think the timing for these types of strategies is very attractive today.
Okay, let's take a deeper dive into one of your ETFs, the Range Nuclear Renaissance Index ETF. That ticker is NUKZ, N-U-K-Z. What does the fund own and what makes it unique?
Sure. So it's unique in that it's really the only dedicated nuclear power ETF. So there are uranium ETFs in the market. We still love the uranium theme, clearly tied at the hip to nuclear power demand. What we wanted to provide was exposure to the entire ecosystem without the mining risk. So it owns nuclear utilities. It owns companies involved in small modular reactors, which are kind of the future of nuclear power as we see it. It owns companies that produce specialized fuel for those small modular reactors. And then it owns many of the services that are involved in actually constructing and operating nuclear power plants.
So then how do you see Range ETFs being used by investors and financial advisors as part of an overall portfolio?
So we think these are all secular themes. I think if you look and kind of zoom way out, in some ways we're making a bet that, things are going to stay the same. These are not big bets on kind of technological disruption. This is our saying fossil fuels are here to stay. Nuclear power is here to stay. We think these are great solutions for equity components of portfolios, but particularly those investors that are looking for energy exposure. And that's a bit more niche than owning the XLE or, just kind of the large cap major oil producers.
All right. Well, Tim, thank you so much for joining us, sharing more about your ETF NUKZ. It's great to have you.
Thanks for having me.
Investment income from non-traditional sources like options can help to diversify your income stream. It may also enhance a traditional all stock and bond portfolio's overall income strategy by providing alternative and higher income. Here to elaborate is Rory Ewing, portfolio manager with Neuberger Berman Option Strategy. Hi, Rory. It's great to have you here on First Look ETF.
Hi, Stephanie. Thanks for having me.
Okay, so how can an allocation to an option strategy like the one used by Neuberger Berman Option Strategy ETF, and that ticker is NBOS, complement an existing portfolio with traditional allocations to stocks and bonds?
Yeah, well, thanks. Well, listen, equity markets are at or near all-time highs, and any bond exposure comes with a near unprecedented uncertainty attached with it. So we find that the old paradigm of sort of reallocating or trying to manage risk by rotating between equities and bonds and rebalancing, it's very fragile right now. And people are looking for an innovative structural solution to have a diversifying return source. And we believe this can be accomplished with options, specifically with equity index options when used in their core sort of fundamental way, which is underwriting. by underwriting, you can get paid for equity risk and get compensated for it in an upfront cash flow. That upfront cash flow is a very attractive way to generate a return stream. And further, it can be fully collateralized with a short duration US Treasury portfolio. So with yields at 4 to 5% right now, harnessing that US Treasury rate, along with some active premium capture from how you're choosing to get paid, together can create a defensive, very risk-efficient return stream that can really fit very well between equities and bonds. And structurally, you're getting paid explicitly for equity risk, but you're getting paid in a bond-like format with the benefit of 4 to 5% from rates coming through. Now, most importantly, we want to do it in a systematic way with no leverage, where we're removing unnecessary complexity. And when it's done in that format, you can really optimize your exposure to the behavioral and mathematical benefits associated with getting that risk through options.
And so on that note, expanding on that, what are some of the common portfolio challenges facing investors that a fund like NBOS might solve then?
Listen, we see three fears out there that sort of dominate the market. The first one is rates. Higher for longer, no one knows what the Fed's going to do or when it's going to do it. The second is higher volatility, whether it's for politics, geopolitics, economics. So volatility is likely going to be in our future. We may not know when, but it will come. And finally is equity markets. They're at tops. Is there a chance that equity markets are going to stagnate and people are worried about that? For sure. We've all relied on cheap beta for decades to provide for our clients. And the possibility that those all happen at the same time is almost like an Armageddon scenario. Higher rates for longer, beta failing to produce, and it all happening in a volatile manner. Now, with NBOS, we believe we found a way to not only alleviate those fears, but to actually monetize them. You can monetize the higher rate environment through a short duration treasury portfolio. Enjoy that 4 to 5% of coupons. Any volatility that comes along, collect a bigger cash flow as compensation for that long equity risk. And if markets were to stagnate or be more, less directional, you would just keep more of those cash flows. So it's a very interesting solution to try to, create something that is going to mitigate your downside. It's going to produce for you in a flat market, and it's going to at least partially participate on the way up, all by monetizing volatility while trying to earn some income.
It does sound like a unique approach. Then how can portfolio managers and investors use NBOS as part of their overall portfolio?
Yeah, it is unique. And we joke that one of the most unique portions of it is that we're actually trying to collect and maintain a cash flow from the options, right? The entire return stream is based on the collecting and compounding of cash flows from the short duration treasury portfolio and from the active premium capture from the option strategy. Now, this is unique in that it can add a very risk efficient, again, defensive equity exposure return. It's trying to provide a structural diversification to common low vol equity solutions, whether it be an actual low vol equity or an equity long short or high yield. And also really importantly, we want to be unique within the growing option universe as well. Most options are used to gain control over something else. And what I mean by that is that the dominant portion of option strategies out there, the underlying collateral is a beta 1 equity-like exposure. Options, generally either long puts or short calls, are getting you short directionally, which is helping to control the volatility of that beta 1. And that's fine. The volatility control and damping is valuable, but they're not actually creating cash flows over the long run. So we're trying to be unique in that our entire return source is optimizing the behavioral benefits, the mathematical benefits, and letting the options collect and compound, all while remaining liquid and transparent and cost effective as an alternative source of yield and return sources.
And we'll leave it there. Rory Ewing, thank you so much for your insights. Keep up the great work.
Thank you, Stephanie and team.
Investment income from non-traditional sources like asset-backed securities can help to diversify your streams of income. It may also enhance your overall income strategy by providing higher and more sustainable income. What's not to like about that? Well, here to elaborate is Alex Morris, Chief Investment Officer at FM Investments. Hi, Alex. It's great to have you with us.
Hi, Stephanie. Thanks for having me.
Okay, so among your firm's latest ETF launches are funds targeting the corporate bond market. The ticker symbols are ZTWO, ZTEN, and ZTRE. Break these down for us and tell us how they work.
Great, happy to. So we call them Z2, Z-Tray, and Z10, and you'll hear me use them as such. And they really complement the US benchmark series that we launched, which were novel single treasury ETFs. Not because we wanted to launch things that were single treasury, but rather we wanted to provide people very specific exposure to the US Treasury markets in the same way that we as institutional managers have a variety of tools available to us. Now, fast forward a year and a half and $4 billion of success in that series, we wanted to give people that same access, but now within the credit space. Most folks have been very happy with the material return in the Treasury space they've gotten for the last 18 months, but are looking down the road saying, what happens when rates are cut? Fed rates are cut, overall rates in the Treasury market come down, and now it's time to go into the investment grade space. But how do I do that without giving up that same level of precision that I've come to appreciate, or realistically that we think many folks will come to enjoy? When you look at, say, Z2 versus a larger fund like an IGSB, we'll hold 370 or so bonds as opposed to the 3,700 that you'll see in some of these larger multi-bond funds. And it's not that holding a lot of bonds is bad, it's that it's an interesting diversification technique, but it sort of necessarily moves you away from the essence of what you're looking for, which is a current coupon experience from the issuers in the market, not a debt cap weighted issuance of everything that has happened over the past few years. And that level of specificity, the ability to derive a current market experience, so the dividend yield that you get looks more like the coupon and the current yield that you're seeing in the marketplace, as well as having that precise control where maturity and duration can stay exactly where you as an allocator set them, we think are really important tools for us, and it's why we use them, and we think the market will tend to agree with us.
So what are the advantages of choosing bond ETFs with a targeted maturity versus buying individual bonds?
Well, to anyone who really wonders about that, we say go ahead and try. We buy individual bonds frequently. It's what we do as an institutional fixed income shop, but it doesn't mean it's easy. The process is little changed over the last 10, 50 years or so. Yes, we've added electronic means that make it faster, but practically trading bonds is very different than trading ETFs or trading equities. There's no centralized exchange. There's no centralized source of pricing. It is a very relationship-driven model where who you know in the brokerage world will actually determine the price and the quantity and the ability to trade at all. And beyond that, because it's not an exchange traded item, now settlement becomes an issue. No one in their brokerage account buying stocks much worries about will those shares of Coca-Cola show up. But when you're buying bonds, even treasuries, that settlement process is much more difficult and it's much more expensive to do. So you could go out and we could buy 370 bonds for you in your portfolio, and many retail brokerage firms would charge $8, $10, $20 per trade per allocation to just receive those bonds in the first place. So it becomes really expensive. Then on top of it, if you don't have those relationships or you have just one or two, you're going to find it very hard to get competitive pricing, at least anything close to what would be considered best execution. And those relationships need to be maintained over a very long period of time to remain valuable. So it's just hard. And then on top of it, if you go and search for, say, Ford today, they have one equity ticker, but they have several thousand other tickers. And so buying a Ford bond sounds simple on its face. Then you try to do it, and you first have to answer which one. And once you get that done, then the hard work actually starts.
Okay, so before we let you go, how do you see the FM corporate bond ETFs being used by investors and financial advisors?
We hope in many, many places. But most realistically, we think we'll see some folks who have already come to enjoy precision within the Treasury space, who will now look for that and demand that in the investment grade space. We think there are a lot of advisors who want something better than the investment grade and the credit answers that they have today. And then other asset managers like us who may take 6 or 8 weeks to invest a portfolio or have a handful of retail SMAs might find this a really useful tool for a portion of their allocation to access liquidity quickly and to provide immediate and full investment against the markets without having to go and source a bunch of bonds or take bad pricing as an option.
All right, we'll leave it right there. Alex Morris, Chief Investment Officer at FM Investments. Thank you so much. It's good to have you with us.
Thank you.
And that does it for today's episode of First Look ETF. If you enjoyed the show, tell us in the comments section below and by hitting the like button. A cordial thanks to all of our guests, along with Douglas Yones from the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thanks for watching. We'll see you next time.